So it is August 2024. What's going on in the housing market? So Fed decision July 31st, 2024. In support of its goals, the committee decided to maintain the target range for the federal funds rate at 5.25 to 5.5%. They maintained it there, but I think we have some ones coming, some cuts coming. Jobs report was weaker than expected, and we've seen interest rates actually drop to about 6.25, 6.5. Mark Zandi, chief economist, Moody Analytics, said the Federal Reserve stuck to script, holding monetary policy unchanged, but strongly suggesting a rate cut is likely in September. The inflation data must cooperate for the Fed to follow through, but all indications are that it will. Global investors are cheering by this. Stocks are up a lot and bond yields are down, as they should be. The economy is set to a soft landing. Now, we all saw in the markets, we had a little calamity in the stock market for a while, with a lot of things kind of being sold off, but then it kind of bounced back a little bit as well. So, how does that affect the markets? As interest rates come down, we are seeing, a little bit more, not necessarily demand, but people will spend a little bit more because it's a little bit cheaper for them to purchase. We still have low inventory, and this time of year in August, it's normal to be quiet. We're a little bit quieter out there with new inventory, even buyers that are out there. I do think a lot of that is really just seasonality. For August, people are away on vacation, you have school, people going back to schools, all of that. So, one of the big factors that, people are factoring in that the Fed's are going to cut rates is that the unemployment rate is rising a little bit, which, overall is not a great thing, but it's not terrible seeing where the numbers are today. And that's kind of what the Fed was looking for to get that up so that the economy slows down a little bit. Lawrence Young, the chief economist at NAR, said mortgage rates are plunging on the news of weak job growth and rising unemployment. Once again, keeping those rates kind of in line. So here's what that means. If you were buying a house in April for $500,000 at a 7.52% mortgage rate, your payment was about $3,500. Now, with the same loan amount, but a 6.4% interest rate, your payment's $3,127. So you're talking about, a $370 a month difference. That's a big difference, when people are out there and trying to figure out what their expenses are. I'd say that that's a car payment, but let's face it, they're more than that these days. So as these rates drop, we will see people probably spending a little more. And you've heard me say that as rates are in the sixes, I think we'll see some price appreciation. When they get into the low fives is when I think we'll see some leveling out, because more people will put their home in the market, because it will make sense to go from that 3.5%, 4% interest rate to get into that 5%, whether they're moving up or moving down or moving out of state. So the hopes for lower interest rates need to really check out. The lower doesn't mean we're going back to 3% interest rates. Mortgage rates are 7% now, and the best we may be able to hope for over the next year is 5.5 to 6. And I think that's probably realistic, for that. So, the 3% days are gone. We may not see that again in our lifetime. Our children may. They may not. We'll see what happens with that. But I think if ultimately we can settle back down in that 5 to 6 range, I think it's pretty good. Being 6.25, 6.5, like I said, it's about that national average for the last, I think, 40, 50 years. Norda Real Estate Investment said experts forecast lean towards a moderation in home price growth over the next 5 years. This translates to a slower and more sustainable pace of appreciation compared to the breakneck speed witnessed in recent years, rather than a free fall in prices. I agree with that 100%. When you look at nationally, like we talked about, you are seeing some price declines in some of the other areas, but even Florida as an example. The East Coast is still doing pretty strong. The West Coast has seen a little bit of a price depreciation. Nothing crazy. And even though that's not our specific market, we will ultimately get a little bit of that one way or another. So I don't see any major price declines. And it's the same thing. If you're buying a home and you're going to be in there for 5 or 10 years, same and price declines, so what? You're not selling it. And as long as you're locked into a fixed rate and you can afford it, you're in good shape. And the same reason why our 401ks or retirement plans, if they go out there and they are, dipping a little bit, we don't panic and sell if we don't need the money. We plan accordingly to where we are with our life. 2024 home price forecast. I think the average is probably about 2.5%. The highest one is Fannie Mae at about 6.1 and the lowest at Freddie Mac at 0.5. I think that for us here in our area, I think we're going to see anywhere from 5 to say 7.5% price appreciation, and we'll continue to see that probably into 2025, I'd say. So we're seeing a little bit better than modest. So we're seeing a nice growth, not the boom numbers that we saw a couple years ago, but I think that's overall healthy for the economy. You're seeing kind of most people are seeing, most of the analysts are seeing a steady growth of about 3% for 2025. One of the big things that I think is actually important here, where people are like, oh, if we have a downturn, we were talking about recession a few weeks ago, what does that do for the housing market? So the 2008 housing market was largely based on borrowed money and prices were so inflated and there was a huge amount of debt. What you're looking now, from 2000 versus 2024, the real estate values are about 45.8 billion. You have the home equity at about 32.8, but the debt is only about 13.1. So the debt compared to the actual value is still pretty low. We're about a little less than a third. So you know what? That's pretty good overall for where we're at. Where in 2008 it was probably like 50, 60%. So I like that stat. I think that's really good for us to kind of manage and go through. Danielle Hale, chief economist, Realtor.com, said for most homeowners, capital gain tax exclusion, which allows you to pocket the first $250,000 or $500,000 if married in gains on the sale of your primary home without having to pay taxes on, means that you're not likely to pay taxes on the proceeds from your home sale. But homeowners who have lived in the home for a long time or have seen substantial home gains should be aware of that potential tax implication. So what does this mean? If it's your primary residence, you have between $250,000 as a single, $500,000 as a married person of capital gains. You're tax exempt as long as it's your primary residence. Double check with your accountant and whether or not that applies to you. But this is a great thing. So if you're selling your home at a high number and you're going to buy, something in a different area where prices are down, you most likely won't pay capital gain tax depending on what you ended up buying the property for. So something to consider because that does really dictate a lot. So to summarize it all, right now, market's still very strong. We're seeing interest rates go down a little bit, prices go up a little bit. August a little quiet for inventory, overall, but I think we're going to see that pick right back up come September. So any questions, feel free to reach out. Happy to go over what's going on in your world.